Hello, and welcome to this super brief overview of the classified balance sheet. So, when we hear the term classified balance sheet, it may seem complex, but it is really super easy. All it means is we are going to break down our balance sheet into categories, okay? Just so that the balance sheet is a little bit more useful to readers. And you'll see that I have current assets and current liabilities, highlighted here. That's just because that's one of the relationships that's really the most significant that we often evaluate based on a classified balance sheet. Current assets, those represent assets that are expected to expire or be converted to cash within 1 year or the operating cycle, whichever is longer for the vast majority of companies. That is going to be 1 year. Common examples of current assets are going to be things like cash, short term investments like marketable securities, accounts receivable, short term notes, inventories, prepaid expenses, those sort of things. Okay. Our long term investments, some companies may not have anything in this category, and so you don't always see this category on the balance sheet. But if a company is specifically holding long term investments, they would put those in its own category. Okay, now that differs from our long term plant assets. Long term plant assets are those that we are using in our business operations. Okay. Long term investments are going to be investments. We're not using these in the business operation. We're just holding them, basically hoping that they're going to grow in value or, that we're going to make money off of them somehow, but they're not used in the business. Plant assets and intangible assets are used in the business. Plant assets are going to include things like land, buildings, equipment, machinery. These are often also called, sometimes you'll see them called fixed assets or property, plant, and equipment. All means the same thing. These are our plant assets. Intangible assets. These are our long-term assets that lack physical substance. Some of the more common examples of intangible assets are going to be things like patents, copyrights, trademarks, franchise rights, goodwill, things along those lines. Again, it's going to be things that the company needs for their business. Okay, we hop over here to liabilities, and this breakdown is much, much simpler. We only have two categories. Liabilities are either going to be current or they're going to be long term. Again, if we expect to satisfy the liability within 1 year, it is going to be a current liability. Longer than that, and it's going to be a long term liability. Equity is very simple. We normally break equity down into what we call contributed capital, which is common stock. And if a company has additional paid in capital, that would also be part of contributed capital. And then the other element is retained earnings. And again, just having this classified balance sheet allows us to quickly make evaluations in terms of the relationship between certain accounts. For example, as we'll learn a bit later, people commonly evaluate a company's liquidity based on the relationship between current assets and current liabilities. Now, if this balance sheet were presented with all of the accounts grouped together, could you pull out the current assets and calculate the total current assets yourself and calculate the total current liabilities yourself? Sure, you probably could, but that would be quite a hassle, right? And most financial statement readers are not going to want to do that, so they expect to see a classified balance sheet where those important totals like total current assets and total current liabilities are broken out for them. Again, it makes it a lot easier for calculating ratios. So I hope that this short lecture has been helpful to you.